Good morning.
Good morning, everybody. And welcome to Coffee with Bob today. Christina, of course, the hostess with the mostest, is here. And today we're going to be talking about post-election market trends. Interesting debate last night. Some sparks were flying, and I'm sure more will from the next three debates. In any event, we're going to get started. Chris?
Thank you, Bob, and thank you again, everybody, for tuning into this latest episode of Coffee with Bob. Coffee with Bob is a mini webinar series brought to you every other Wednesday. We cover timely topics, and today we're covering post-election market trends. You may recall from a previous episode where we discussed what the markets typically do leading up to a general election, and if you haven't seen that, you should check out our YouTube page and you can view that episode at your leisure. Today we're focusing on what the markets typically do after an election. So right after the election, within the first 12 to 24 hours, as well as a little longer term as well, 1 month, 3 months, up to 12 months after the general election. Just one housekeeping item, I mentioned it very briefly, but our YouTube page is live. So search Hapanowitz and Associates YouTube. It will take you right to the page and you can see all previous episodes of Coffee with Bob. And we're going to be bringing some great content through that page to you guys. So please check it out and subscribe as well. So let's jump right into it. Bob, just like you were saying, especially relevant today given that feisty debate last night. We're going to start this off with a couple throwbacks for you guys. First, starting with the 2016 election. Oh yeah, and we have our cups of coffee in true form. I'm drinking tea, so not to turn off anybody who doesn't drink coffee. Tea drinkers, water drinkers, pop drinkers, anybody who likes to hydrate, please tune into Coffee with Bob and share this with anyone who would be interested. Okay. Let's get started now. Bob, let's talk about this throwback to the 2016 election. I'll turn it over to you.
Yeah, I remember it very well. Everybody was saying Hillary was going to win, and then Trump took Florida, and the stock market futures, I'm in the business, of course, so I check the futures periodically, and the overnight futures just went absolutely crazy, down 500 points in a matter of seconds. As you can see here, at one point, they're down almost 900. And then full recovery by the morning as the market sorted through things. But Trump's victory was unexpected. All the polls said otherwise. I don't even think he thought he was going to win, to tell you the truth. But here we are today, 4 years later, and in 4 or 5 weeks from now, early November, we're going to have another election, and promises to be very interesting as we lead up to that election.
Absolutely. And this chart that you're seeing on your screen here depicts, what the Dow did in the first hours after the election results were released. And, the roller coaster ride it took, it's just absolutely incredible. And the markets recovered, by the next morning, as Bob was saying. So, just an incredible, event that took place in the markets as a result of an unexpected election result. Let's look at another throwback, the Bush-Gore election and the market's reaction to that. This covers a little bit longer of a timeline. This covers the couple of months after election night. Bob, why don't you talk about this?
So, this could replay this time around too, where you have this extended debate, things are challenged, the U.S. Supreme Court had to be involved, and of course Trump, with the death of the very honorable Ruth Ginsburg, would like to appoint and get confirmed ACB, and those confirmation hearings for Amy Coney Barrett are going to be in a couple of weeks. So, and it's very likely that she'll be that she'll be confirmed as the 9th justice. And that sets up a conservative Supreme Court, and likely tilt in a conservative fashion. That's generally what happens. So, in any event, we could have a replay of this slide through this election, as this looks like it's going to be pretty closely contested.
Yeah, especially with, mail-in ballots and, there's just so many other factors playing into this upcoming election. We do think that it is, very possible for this kind of thing to happen. So there's a couple reasons why we wanted to talk about these two stories, the 2016 election and then this election back in 2020. And that's because there are some trends that you can see here. So let's go to the next slide, Bob. Bottom line, can you ever fully predict 100% what the market's going to do as a result of a presidential election? No, you can't, in our opinion. But what we do think you can be prepared for are certain trends that have been picked up from previous election results. And you can see them here on the screen, the main ones. So number one, markets don't like uncertainty. Trump winning the election was correlated with some uncertainty at first. The Bush-Gore election results, how they couldn't even be, determined right away, that's uncertainty. The markets did not like that. And therefore, what you see is a lot of volatility. Markets typically react to regime changes, so a Democratic president to a Republican president, or the Senate, or any other facet of our government. Any sort of regime change is typically not doesn't go over well with the markets in terms of volatility. What we do see, though, is that typically that rise or fall happens within the first 3 to 6 months of election results. And then what the studies show, what the data shows, is that they tend to go back to, or at least close to, that equilibrium. And it doesn't matter who won. It doesn't matter if there was a regime change. In the long run, the election results don't have as big of an effect on market results as we might tend to think, because we are so thrown off course or so surprised at a general election result. So what you can do is pay attention to these trends and prepare yourself for what's to potentially come in early November. Okay, so what we did here is talk about market reactions right after election results, or at least election night occurs. Expect volatility, in our opinion. Let's look a little more long-term. If we want to go to the next slide, let's talk about the 12 months, after the election, the calendar year following the election. We're going to stay within the realm of U.S. stocks for this episode. Bob, why don't you tell us about what we can typically expect from U.S. stocks, based off of what we've seen in the past?
So we're in the fourth year of Trump's first term, and the fourth year of a term is usually associated with very good market returns, as all the ducks are lining up for the incumbent to be reelected. So that's typically what you would think happens. Historically, that's what's happened. And then the first year in office is sort of a little anticlimactic as things get sorted through. The biggest thing, though, with corporate America is they just want to know what the rules are. Once they know what the rules are, they can act and they can decide how they want to invest, and any changes that they need to make or want to make. So the biggest issue is knowing what the rules are. How can you plan if you don't know what the rules are? So that's where volatility can come to play if we don't know for an extended period of time who's going to, who will be in office. And again, the polls are pretty tight. They're within the margins of error, so it could go one way or the other. And at this point, so you wonder, are you going to have the current tax policies in place and maybe some more tax cuts? Or are you going to have sort of a retracement back to the old tax laws? We just won't know for another 4 or 5 weeks.
Yeah, and
even longer.
You may have already mentioned this, but typically the markets already factor in, they already price in those potential policies or events that could be put into place due to one candidate winning over another. Isn't that right?
Yep. And the markets have had a lot of time to sort through all the possibilities here over the last several weeks. And they are fairly efficient in the longer term. And occasionally you'll get something that throws a monkey wrench into it. But for the most part, the markets anticipate all the possibilities. And they've already we think, for the most part, priced things into the markets as we see them today. And as we're talking now, the Dow's up almost 400 points. And so it's liking a lot of what it's seeing and hearing about the economic recovery coming out of COVID here.
Absolutely. Look, if you want to look at it within the span of the 4-year presidential term. Typically, that first year within a presidential term, compared to the other 3 years, do have the poorest returns. But when we say poorest, it's not necessarily a bad thing. You can see on the screen, since 1928, average annual S&P returns 5.8%. So it doesn't necessarily mean that you're going to have a down year if one person wins over another, or just because it's that first year within the presidential term. So, again, trends that you can use to prepare yourself, but we'll never know 100% until things play out. Okay, so we love this chart here. It takes a look at S&P returns over each president's term, whether it's 4 years or 8 years, and it orders it by the highest S&P returns, the biggest S&P returns. Bob, talk about the significance of this chart for us.
The significance is the Republicans are sitting here saying they set up Clinton and Obama for those wonderful returns. And by the same token, the Democrats are saying they set up Eisenhower for his run and the market performance when he was in office. So that's all this really means. And again, there's a lot of factors behind just being a Democrat or a Republican. You have to look to the previous years and see what transpired and where the market started before you can say, that was a wonderful thing or not relative to other presidents. So no, I think the biggest thing that you'd probably see from this is the politicians taking claim for the other party's success.
And also, what does this mean for us as individual investors? Well, there is a common thought amongst a lot of people that typically Republican presidents are favored more by Wall Street because of their business-friendly policies. And this shows that there's really no trend in terms of Republican versus Democrat. In the long run, as investors, should we be overhauling our investment game plans just because one person is in office over the other, or one party has control over the other? In our opinion, not necessarily. Okay, so let's talk a little bit about, let's go to that next slide, and we're going to get into just a little bit some specific Trump versus Biden stuff. And we've got the general talking points here on the screen. So Biden, his proposal to increase fiscal spending, that can be incredibly expensive to do so, but it could potentially offset the negative effects of less favorable tax laws that would be expected if he were to win the presidency. Also, he is viewed as in general, he is viewed as the candidate who would maybe have a steadier relationship with China, between the US and China. On the other hand, Trump, likely continuation of lowering taxes, or at least keeping them at the same levels that they are now. He's also known for his relaxed regulations compared to a typical Democratic president. That could potentially offset, some negative effects from trade tensions, COVID-related hardships as well. The point we're trying to get here is that there's a give and take with each candidate, as there always is in any general election. And, it's going to be up to us to react to the information that we can know for certain once we know which candidate does get into office. But let's talk about this again in a little more detail. What we have on this screen is a list of the issues besides COVID that investors and individuals and we are really paying attention to right now. And these are the top issues that each of the candidates have on their radar as well. So at least some of them. Bob, let's pick out one or two of these and, what they mean to you.
So I think the most important thing, our role as your investment advisor, is to monitor the market, monitor the issues, and report to you with timely information and make recommendations, or in some cases, just manage your account, which we do. So, what we have here are some of the significant issues. Last night, one of the big topics was healthcare and Obamacare, and Trump was talking about prescription healthcare prices and how his administration is attempting to drive those down significantly from the past administration. So that's one big issue, we think. And then corporate taxes is another. With Trump's tax law changes, C corporations are paying at a rate of 21%, and I am positive that the Democrats would like to reverse those. That's what they've said all along. So, and that would affect corporations. Again, the corporations want to know what the rules are. They can, once they know what the rules are, what the playing field looks like, they can make adjustments and move forward. But in this case, these issues are all front and center. Infrastructure plans, they both want to do an infrastructure plan. One wants to do it a little bit different way than another. But one is all, sort of government backed, and the other is sort of a consortium of private and public money to get roads and bridges and things built. Mm-hmm. But in any event, a lot of issues to be decided. And again, our job as investment is to monitor, look for opportunities, and bring those to you.
Yeah, I think the general message here is each candidate has these issues on their radar. They each have their own thoughts or game plans as to how to go about addressing these issues. And those different game plans have different implications for, the multiple facets of the economy, the different sectors of the markets. And as Bob said, we can't reiterate enough, it's our job to stay on top of those things and make adjustments as necessary. So let's round this out with our do's and don'ts of how to respond to market volatility as a result of a presidential election. So I'm going to start us off with the don'ts, and then I'll turn it over to Bob. In our opinion, from our experience of reacting to presidential elections past, we don't necessarily think that you should panic over volatility. We actually think that should be expected. And as long as your long-term goals and objectives are intact, in our opinion, we don't really think you should be abandoning your long-term investment game plan as well. That doesn't mean that we aren't going to, make any moves or any changes within portfolios that we manage, but they'll probably be tactical and strategic rather than, big overhauls for the most part. And, that's typically what we've seen in past elections. You never know. Things can always change. That's the beauty of this business, is if we need to make changes, we absolutely can. But in general, we tend to caution against abandoning, and overhauling your long-term investment game plan just because one person gets in office over another. I'll turn it over to you for the do's, Bob.
Yeah, the big thing is you've hired us to manage the things that can be controlled and manage them in a way that is beneficial to you. And so as long as Chris said, as long as your longer term goals and objectives are unchanged, you should attempt to use volatility to your advantage. So that's a thing that we can manage. We can't control the volatility, but we certainly can manage it and take advantage of dips and extremes. As we did earlier this year, we were buyers of stocks in March when the market dipped, and we sold and harvested gains about a month ago in portfolios as portfolios became overweight. And that's what we do. So we look for these opportunities all the time. Our investment committee is tasked with doing this all the time. Mm-hmm. And so we think, again, manage the things that you can control. If there are tax law changes as a result of a change in office, then we'll communicate those with you, and we can talk about what's appropriate for you and your family, your portfolio, your wealth. Mm-hmm. So I would just I would rely on the experts to help you out and assist you. Of course, we welcome any calls and conversations along the way, but for the most part, I think the fifth bullet point here is going to be meaningful.
Yeah, so do stay tuned for an upcoming episode from us. We're going to be trying to bring a couple more election-based episodes your way. One of them specifically, the first Coffee with Bob episode after election night. Hopefully we will have the results clear by that time. And we're going to be having a CPA, a very prominent CPA in the Pittsburgh area, on as a guest. And we'll be talking in a little more detail about the potential tax savings strategies and tax planning strategies that you could think about using depending on who wins this election. So please stay tuned for that. Thank you everybody so much for tuning in today. This was a great episode. If you have any questions, please do reach out to us. Our emails are at the bottom of the screen. You can also call us at 412-261-5966. I do see that there's a few of you tuning in through the phone. We are going to be sending out this recording to you guys once it's ready and up on our YouTube page. Check out our YouTube page, search Hapinowitz and Associates YouTube and hit subscribe. 2 weeks from today, we are going to have Bobby Hapinowitz and Bernard Carter back on Coffee with Bob. They are members of our investment committee. They actually both head up our investment committee. And we're going to be giving a market and economic quarterly update. So that's going to be another great episode. In the meantime, reach out to us, use us as that resource, and we really appreciate you guys tuning in. And we'll see you next time. Take care.
Have a great day, everybody.
Thanks.